Hey everybody, welcome to the next video in the series on doing a sample budget for this made-up company called Bill's Fish Market. So what have we done so far? Well, we did an assumptions page, and we've got a nice set of assumptions there. We did an accrual budget, and if you recall an accrual budget, what we do is for every month we record the revenue we're going to earn that month and the expenses we're going to incur that month. Now, the accrual budget, that doesn't necessarily have anything to do with when we're actually going to receive the cash, the money that we earned that month, or when we're going to spend the money, the cash, write the check or whatever, for the expenses that we incur. So what we want to do is, in addition to doing an accrual budget, we also want to do a cash budget. And so we're going to add a new sheet. And before we forget, we're going to rename it right away. And let's call it cash budget. So we're going to end up with three sheets: the assumption sheet, the accrual budget, and the cash budget. Now, for the cash budget, we're going to want a three-line header, and we're going to want the columns for every month, and we're going to want all the rows, very similar to what we did for the accrual budget. So rather than retype all of that, why don't we go ahead and select everything that we did there and copy it. I'm using Control-C, but you can right-click and select copy, and then go over to the cash budget and paste it. And now we've got we copied all of the text and the formulas from the accrual budget to the cash budget. First thing that I want to do here is select all of my columns, and you notice some of them are much too narrow. We want to widen the column. So I'm going to select Format and then Auto Fit Column Width. That will automatically increase the columns to as wide as we need. Also, we copied the formulas here, and the formulas that we used on the accrual budget are, some of them are the same in the cash budget, but some of them are very, very different. So what I want to do is select all the formulas and hit the delete key and just get rid of them. So we're starting with a fresh sheet here, other than, we've got our rows, which we're going to need, in our columns. So the purpose of copying everything over was just to not have to retype all of that information. Now, if you're an advanced user, you might know that some of the formulas we're about to do, we could have left, and we could just modify the ones that are different in the cash budget versus the accrual. But, as an example of what we need to do in a cash budget, I thought that it would be better to start fresh. All right, so now is this all clear of everything that we did in the cash budget or the accrual budget? Actually, no. Notice up here our three-line header. Don't forget to update that. Second line that we copied over said accrual budget, but this sheet is the cash budget, so we need to update the second line of the three-line header. So we have here the outline of what we want to do for the cash budget. So let's get right into some formulas. The formula for sales for January is going to be very similar to what we did for sales for the accrual budget. If you remember, how do we calculate how many fish we're going to sell in January? Well, we take the number of days in January, we multiply by the number of fish we're going to sell per day, and then the price per fish. Now that, however, does not indicate how much cash we're going to receive. We'll address that in a second here. But first, let's just go ahead and calculate how many how much dollars we're going to generate in sales in January. So we'll take the 31 days in January times, on the assumptions page, 100 fish per day times the $2 per fish. And that says we're going to sell $6,200 worth of fish in January. Now, I want to be able to copy this formula for every other month. In order to do that, though, I need to add the dollar signs to my references to the assumptions sheet. Otherwise, those cells will be updated when we copy them over and won't refer to the correct numbers anymore. So once I add the dollar signs there, I can copy over it and say, yep, I'm just like I did in the accrual budget. I have got how much in fish sales I'm going to incur in each month. Now, that's great for the accrual budget, but here on the cash budget, what we're really concerned about is how much cash we're going to receive in each month. And just because we sell $6,200 in January, are we going to receive that much in cash? In a retail operation, perhaps we would, but if you recall when we went through the assumptions, we talked about that for Bill's Fish Market, sales are done on credit. So they're not going to collect 100% of their sales in January. They're only going to collect 80% of it, and then 10% the next month, and then 10% the month after that. So that $6,200 in sales that they're going to generate in January, they're only going to collect cash 80% in January. 10% of that $6,200 they'll collect in cash in February, and then the final 10% they'll collect in March. So how would we do that in Excel in this budget here? Well, what I would do is add a row underneath sales there. So I'm going to select there and then go to Insert Row. And here I would have a row that below sales that says cash received. And what I want to do here is calculate how much actual cash we're going to get that month for each month. And then some of our future calculations will be based on the cash received. So let's just do it real quick. So again, how much cash are we going to collect in January? Well, we're not going to collect all of January's sales. We're only going to collect 80% of it. So how would we do that? We would say equals January sales times, and then go click on the assumptions page, that assumption we have for 80% collected in the same month. And that says we're going to collect $4,960 in January sales. One thing you might think about is like, oh, how about the previous years? Are we going to collect money for November and December sales in 2015? Well, one of the assumptions we have is this is a brand new company. January of 2016 is the first year they are in operation. So no, this is all the cash we're going to receive is just the 80% of January. How about February? In February, we're going to collect 80% of February sales plus the amount collected in the second month of January's sales. So that 10% of January's sales we're going to collect as cash in February. So how would we do that formula? Well, we would say equals, let's do February's first. We're going to take February's times, on the assumption, the 80%, the amount collected the same month, plus, now we want to go back to the cash budget, pick the January sales, and multiply by times, on the assumption, the amount collected the second month, because we're in February, so it's the second month for the January sales. So click on that, and we get 5,260. Our formula looks something like this. Now, some of you know, I did the February's times 80% plus the January times that 10% collected in the second month. some of you may prefer, you might say January times the 10% plus February times the 80%. Does that make a difference? No. You can see, some of you may be concerned here about the order of operations. Is Excel going to do the math correctly here? Because I've got one number times another number plus another number times another number. The order of operations says Excel will do the multiplication first and then do the addition, which is, in this case, exactly what we want it to do. But if you're concerned, it can't hurt to add some parentheses here. We could put the parentheses around the calculation for February cash received plus the amount from January if we wanted to. Again, in this case, it won't affect our calculation, but it does make it more readable, more understandable. So I encourage this, not required, but generally, you know, parentheses, even if they're not required, can be a good thing just to make sure. All right, so do we have a formula here? Great. Now we're going to do a formula for March. Now notice here, we're not worrying about adding dollar signs to January or February's formulas because we're not going to copy those formulas anywhere. We can only use those one time, so we don't have to worry about adding dollar signs to copy formulas. But in March here, we are about to do the most complicated formula we're going to do all semester. This is a little bit hairy, but don't worry, we'll take it slow and it makes sense, and it's very similar to what we just did for February. So if we think about it, how much in cash are we going to receive in March? Well, we've got the amount to be collected in the third month for January, another 10% for February, for January, plus we've got the amount collected in the second month, because March is the second month for February. Again, this is 10%. And then we've got the amount collected the same month for March. So March cash received, we're going to get 80% of March's revenue or sales, plus we're going to get 10% of February sales, plus we're going to get 10% of January sales. So like I said, this is a little bit of a hairy formula, but you'll be able to pause and rewind watch if you want, but it's actually not too bad. So what does the formula look like? Excuse me. We're going to say equals. Let's do March's times the assumption for the amount received the same month, because we're in March, plus, go back to the cash budget, February's sales times, March is the second month here, so we're going to click on the amount collected the second month for February, plus, go back to the cash budget, January sales, and March is the third month for January's collections. So we're going to multiply times the assumption we've got for the amount collected in the third month, and then hit enter. And I'm going to say that I predict or expect budget for $6,160 in cash to be received in March. So it should be 80% of March sales plus 10% of February sales plus 10% of January sales. Now, one thing to be very careful of here when you do the formulas, make sure that you're multiplying the March sales by the percentage to be collected in the same month plus the February sales by the amount collected in the second month plus January sales by the amount collected in the third month. The little sample we're doing for Bill's Fish Market here says that the amount, the percentage to be collected in the second and third month is 10%. It's the same for both, but that's not always the case. So we want to make sure we use the correct percentages here in our assumptions. So we've got kind of a hairy looking formula here. Again, if it makes it easier to read, it shouldn't affect the the formulas, but let's go ahead and add some parentheses to make it easier to read. So we're making it clear that we took the March sales times the assumption for the amount collected first month plus the February sales times the amount collected second month plus the January sales times the assumption for the amount collected in the third month. Also, now that we've got March done, we will be able to copy this formula over to April, May, all the way to December, because we don't have any more collections than after the third month. So what I want to do here is I want to leave the references to January, February, and March sales alone. I want to leave them as relative addresses. So when I copy the formula, it updates to February, March, April, May, June, and so on. So here where I've referenced the cash budget, leave those alone. But anywhere where I reference the assumptions page, let's go ahead and add the dollar signs so that when we copy the formula over, it does not update those cell references. And I should be able to take that and drag it over and then get cash received that's different for each month. One thing I want to do before I continue, remember the first row and the last row should be in dollar format, but everything in between should be in comma format. So when this cash received row should be in comma format, and I do not need 2 decimal places, 0 decimal places is just perfect. So let me go ahead and do that. I might want to do a little sanity check here and say, gee, this is curious. My January cash is less than my February cash, and then that's less than my March cash. But after that, the cash goes up and down a little bit, but it generally stays in the $6,000 range here. Something must be wrong. No, nothing's wrong. Yes, January and February, our cash received is lower because we don't have the previous month's cash to collect. Once we go in March, we're collecting 80% of the current month plus 10% plus 10%. So from then on, we're collecting our cash received. So it does make sense that since we're starting absolutely brand new in January 2016, that our cash is going to ramp up and then stabilize. All right. So like I say, those were kind of the hairiest, most difficult formulas we're going to do the entire semester. So if you're still watching, congratulations. You're going to do fine the rest of the semester, I'm sure. Next thing we want to calculate is the cost of goods sold. If you recall from our assumption, we have a cost of goods sold of $1.20 per fish. So how would we calculate our cost of goods sold? Again, we would want to take the number of days per month times the fish we're going to sell per day. We have an assumption for that, 100 fish per day, times the assumption for the cost per fish. So that would look something like equals 31 days in January times the assumption that says we're going to sell 100 fish per day times the assumption that we're going to spend $1.20 per fish in direct material and labor. That comes out to January being $3,720. Now, one important topic here is you might say, well, gee, John, we're going to sell 100 fish per day, but we're not going to collect cash. We're going to collect only 80% of the cash in January. Well, do your suppliers care when you collect your cash from your customers? No, they don't care. They demand to be paid the month they deliver the fish in this example. So you need to base January's cost of goods sold based on how much you sell, in how much you generate in sales in January. When you collect from your deadbeat customers, that has no impact on your cost of goods sold in this example. So 3,720 is absolutely correct. You're going to have to spend that much in cash in January. And again, whether you collect that from your customers or not doesn't impact your what you're going to have to spend. And this is an important example. I stress it because a lot of small businesses run into cash flow problems because they have to pay their suppliers, but it may take them some time, just like in Bill's Fish Market here, some time for them to collect from their customers, and that can cause real cash flow problems and put a lot of small businesses out of business. Hopefully not Bill's. All right. So we've got a formula here for our cost of goods sold for January. Again, we want to copy this formula over. We want to leave the reference to January 31 days. We want to leave that alone so that when we copy it over, it's updated to February, March, April, and so on. But here, where we refer to the 100 fish per day and the $1.20 for fish, we want those to not be updated. So we add the dollar signs. And now we can take that formula and drag it over. And we see that our cost of goods sold does go up and down a little bit, but generally stays in the same range. So we're looking good. All right. What is our gross profit for January going to be? Well, in this case, what we want to do is calculate based on just the cash received. So we're going to take the cash received minus our cost of goods sold, our cash expense for cost of goods sold. So cash received minus, sorry, hit enter too soon. We're going to say cash received minus the cost of goods sold, and I screwed that up intentionally just to show you what it's like when somebody clicks on the wrong thing. So I take cash received minus cost of goods sold, and I'm saying that they've got a cash gross profit of $1,240 in January. Is that profit? No, I've still got some other expenses down here, but so far they are cash flow positive. We'll see how it looks after all our other expenses. Can I just copy this formula over? Yes, because I want to leave the relative addressing here and drag that over, and I see here, great. So now again, I might want to look at this and say, ooh, my cash gross profit does go up after the first couple months, and then it kind of stabilizes. Is there a good reason for that? Yeah, once I'm in March, I'm starting to collect all of my cash from my customers that they for the fish they bought. So it's looking good. All right, let's continue on with our fixed expenses. Advertising, depreciation, utilities are, in this example, not in the real world probably, but in this sample that we're doing, it's exactly like our accrual budget. We had fixed amount. We're going to assume that our advertising, depreciation, and our utilities, we pay those bills in the month they're incurred. So the cash for January advertising, depreciation, utilities is going to be the same as our accrual. So we created assumptions. Our advertising is equal. Click on the assumption we had for advertising expense, and there we've got it. We're going to add the dollar signs to that so that we can take and drag that over just like we did the accrual budget. Depreciation, very similar. Just click on the correct assumption, add the dollar signs, drag it over. Again, in the real world, we might not pay some of these bills until the month after they're incurred, but for simplicity, for this sample budget, the instructions said that they do pay the month they're incurred. So great. So those three are very straightforward. Our insurance is a little different. If you remember from our insurance, we have a $1,200 expense in January that is a prepaid for the entire year. So on our accrual budget, if you recall, we took that $1,200 and we spread it amongst all 12 months. So it turned out to be $100 a month. On our cash budget, all we care about is when do we spend the cash? When did we write the check to our insurance company. The assumption or the instructions say that they write the check for $1,200 in January. So our January cash expense is going to be that $1,200. So our formula is going to be equals, go click on the 1,200 assumption, and our January expense is $1,200. Now, do we drag this across every month? No. How much do we spend in cash in February? Zero. We don't spend anything in February or March or April or any other month. So once we enter the zero for February, we can drag that through to December. Now here you see the format that I've got says that when you've got a zero in a cell, it displays a dash. Some of you may prefer, you can change the format if you know how to display a zero instead of a dash. I don't particularly care which you do. The one thing is I don't want to see a blank here. If it's a blank cell like we've got here, that might lead somebody to think you're missing something. Having either a dash or a zero tells them that you did consider how much your insurance cash expense is going to be for February, March, and April, but it's going to be zero. So whether you have a dash or a zero there, I don't particularly care. So now we've got our fixed expenses on our cash budget. We want to total up our fixed expenses. We're going to use our friend Mr. AutoSum up in the upper right. We're going to double check to see, hey, did AutoSum correctly figure out what we want to add up here? Here it's taking the 4 rows immediately above. That's exactly what we want the calculation for total fixed to be. We're going to leave the cell references to be relative addressing because we wanted to update every column and go there. Boom. Now we've got a cash fixed expense for January of $1,950, for February, March, every other month for $750. Again, a good time for a sanity check here. Does that make sense? You might think, wow, January is much higher than every other month. And there's a very good reason for it. Obviously, that insurance expense. We've got a very large fixed expense that we're going to write a check for in January. And then every other month, we've just got the advertising, depreciation, utilities. They do not vary at all with how much we sell because they are fixed expenses. So by definition, they're not going to vary depending on sales. So looks good to me. Great. Okay. Let's keep going. How about our sales commission? Our sales commissions, you might remember, we have a commission expense of 5%. So we're going to pay 5% of sales. But the other thing that we remember from our assumption here is they are paid 1 month in arrears. So in our accrual budget, we calculated the sales commission for January, and we recorded it in January because we incurred that expense in January. But on the cash budget, we don't care about when we incur the expense. We are concerned with when do we actually pay our salespeople that expense. So we're going to calculate the commission. We're going to say, all right, in January, how much are we going to write or how much are we going to pay in January for commissions? Well, January's commission cash expense would be based on December's sales. We weren't in business in December, so we had 0 sales. So January, we're not going to write any check for sales commission at all. So our January sales commission cash budget expense is going to be 0. In February, we're going to write a check for commissions to our salespeople, and we're going to take 5% times January sales. Now, an important point here. We are going to pay our salespeople based on 5% of January's sales. We're not going to pay them 5% of the cash received. We're not going to pay them 5% of the gross profit. We're going to pay them 5% of sales. Some companies actually make their commissioned salespeople wait. They say, "Oh, we're only going to pay you on when we receive cash," or they might even say, "We're only going to pay you a commission based on our gross profit. Our sales cash received less the cost of goods sold." But fortunately, Bill's Fish Market treats their salespeople much nicer than that. They pay 5% based on the sales, but they pay 1 month in arrears, that's not unusual at all. So how do we calculate this? Well, we take formula. We say, all right, equals January's sales, not February, January sales times the assumption for the 5% commission rate. So we're going to write a check for $310 in February to our lavishly paid salespeople based on their performance in January. Again, I want to drag this formula over, so I'm going to add the dollar signs to that reference to the 5%. And I've got something that looks like that. Looks good. Okay. We're almost through the cash budget. We just got a few more to do. Our next expense is the supplies expense. If you recall, the supplies is actually a semi-variable expense. It's got the fixed component. It's got the variable component. Again, for simplicity, I believe the instructions said we're going to assume that the supplies are paid the month in which they're incurred. So we are going to, for simplicity here, we're going to take 1% of January sales plus the fixed rate of the 2%. So how would we do that? We would say equal January sales, again, not cash received, not gross profit or anything like that. January sales times the assumption for the 1% plus the assumption for the fixed amount, the $200. And I calculate that we're going to spend $262 in January for January's supplies expense. Again, I'm going to add dollar signs to my references to the assumptions sheet, and then I'm going to drag that over. My total variable expenses, I want to add up the two rows above it. Going to use my friend Mr. AutoSum, make sure it guessed correctly what I want to add up, and it did, and great. Now, again, a little time for sanity check. Like, wow, February through December, the total variable looks about the same, but January's is much lower. Well, we're not going to spend any cash on commissions in January, so yes, it does make sense. Next formula, we're going to calculate our total expenses. Here, we can't use the AutoSum button because we've got some numbers in between. We're going to have to create a formula that says equals total fixed expenses plus our total variable expenses. Add that up, and I calculate that in January we're going to spend cash of $2,212. I can leave those as relative addressing, drag the formula over, and look like that. Again, we might want to do a little check here and say, gee, February through December, the cash expenses is pretty flat, but we have a much higher expense cash in January. Why is that? Well, again, the insurance. So now we can calculate our net income before tax. Again, this is based on cash. We want to take our gross profit in cash that we calculated minus our total expenses. So that formula would look like equals our gross profit minus our total expenses. And here we've got negative $972. I'll talk about that in a second, but let's quickly drag that formula over. We can leave it relative addressing, and we've got something that looks like this. Now, let's spend a minute here talking about this before we go on. We've got a negative number here. Now again, you notice in the format that I've got here, negative numbers are displayed in parentheses. That's the preferred way to do it. Some people will display it with a minus sign or in red or something like that. Again, I don't have a particular preference for how you display it as long as it's clearly indicated that it's a negative number. And then you can see here starting in February and so on, we are cash flow positive. But what this means is in January, we're going to be cash flow negative, meaning we better have at least $972 of cash on hand to pay our January bills, or we're going to go bankrupt. This is a very important lesson. Again, a lot of small businesses go out of business even though they're profitable because they have cash flow problems. Here, the problem is that we have a very large cash expense, that insurance we're going to prepay in January, and we've got plenty of sales to cover it, but we're not going to collect all that cash in January. We're going to have to wait till February and March to collect some of our cash. So we are cash flow negative in January. Again, you better have some cash on hand when you start a business. It's not at all unusual for businesses when they start to be cash flow negative, not just the first month, but for the first several years often. So you do not want to start a business with your last dollar. You want to make sure you have cash on hand and do a cash budget to figure out exactly how much you think you're going to lose and be cash flow negative, so you make sure you've got that on hand. All right, next I want to take a look at, hey, February, we're going to be cash flow positive. That's good. But boy, we're not going to be as cash flow positive as we are the other month. Why is that? Well, again, February, we're going to not have as much revenue. We're going to have 80% of February's sales plus 10% of January's. But starting in March, we're going to be collecting March plus some of February, some of April. So it actually does make sense that our cash received minus all of our cash expenses is going to be lower in February, and then starting in March, going to kind of level off, as you can see here. All right, so again, this is very important information here for planning purposes. We're almost done. Hang in there, guys. A few more minutes. Next thing we want to do is we want to calculate the income tax. As you recall from our assumption, the income tax is 28%. And I didn't note it here, but from the instructions, you'll remember that we pay income tax monthly, which is a very unrealistic assumption. In the real world, businesses pay their income taxes usually quarterly. But for simplicity, I'm just going to say, well, let's assume they pay income taxes monthly. And then the other thing we said is they pay it in arrears. So again, we're not going to write a check. We're not going to pay the government anything in January because we had no business. We weren't in business in December. In February, we're going to pay our January income tax, and it's going to be 28%. But the key thing is 28% of what? And this is another very important point. Businesses pay 28% of their net income before tax. They do not pay 28% of their sales. They do not pay 28% of their cash received, 28% of their gross profit. They pay 28% of their net income. In other words, their income minus all of their expenses are what they pay income tax on. So if you own a small business, you want to keep track of every single expense you incur that could possibly be related to your business, because every expense that is related to your business, you might be able to deduct from your income tax or your income before you pay income tax. So every dollar in expenses that you can deduct from your revenue, in this case, would save you 28% on tax expense. So you want to be very careful to keep track of all your expenses, talk with an income tax professional, make sure it's an allowed deduction. And I'm not giving tax advice here. I'm not qualified to. I'm not a lawyer, not a tax accountant. But it's very important to keep track of all your expenses, because you may be able to deduct them from your revenue before you calculate your income tax liability. So in this case, what we want to do is we want to take that assumption of 28% and multiply it by January's net income. So what does that look like? Formula is equals January's net income, in this case the negative 972, times the assumption for the 28%. Hit enter, takes you back, and I say, all right, we've got a cash income tax expense of negative $272.16 for February. Again, this is a very unrealistic assumption. What I'm saying here is that the United States government is going to send us a check for $272. Spoiler alert, the government does not send you money if you lose money the previous month. But in the real world, actually what we would do is we would have a credit that we could apply to later months. So again, just for simplicity, let's go with it. Let's pretend the government would send you cash. We're going to add the dollar signs to that assumption for the 28%, and then we'll be able to drag that formula over, and you can see, yes, we've got a negative income tax expense for February because we lost money in January, but from then on, we've got a positive income tax expense that we're going to pay in cash. And we can see that it does step up as we make more profit, which is a good thing. We pay more in income taxes, which is a good thing. Nobody likes paying income taxes, but you know what? If you're paying more in income tax, that means you're making more money. So I think it's a good thing. All right. What do we do now? We calculate our net income after tax, which is just going to be our net income before tax minus our income tax cash expense for that month. So we're going to say equals net income before tax minus income tax expense. January we had 0. We're going to drag that over. We don't need to add dollar signs because we leave it relative addressing. Uh-oh, we've got a problem here. March. What are all these hashtags? Oh, big problem. No, it's not a big problem. Just means that our column is too narrow. We're going to double click there and see that our March cash profit, net income after tax, is projected to be $1,008.64. Last thing we want to do is we want one cell that adds everything up, January through December of our profit or loss all added together. We do that using the sum function in Excel. We type equals SUM, left parentheses, left click on our January net income after tax, hold down the left mouse button, drag it over to December, enter the right parentheses, and hit enter. And I'm showing that we've got a net income after tax or profit projected for the entire year of $8,067 and change. Again, I'm leaving 2 decimal places for our income tax, net income, and total net income after tax. Here makes sense to me to display the 2 decimal places on this small a budget. When we do larger budgets, I do not want to see the decimal places. Another thing I want to do is let's compare our cash budget with our accrual budget. We say we're projecting here that we're going to have after-tax cash profit of a little over $8,000. On our accrual budget, we're saying we're going to have an accounting or accrual profit of $8,847, which is almost about $8,800 rather higher than our projected cash profit. does that make sense? Well, yes, it does make sense, because if you recall, in our accrual budget, we're accounting for all of October, November, and December revenue in October, November, and December. On our cash budget, we are projecting that we're not going to collect all of those sales in October, November, and December. Some of that money is not going to be collected until January and February in the next year. So it kind of does make sense that our projection for our cash profit is a little bit lower than our projection for the profit on the accrual budget. And again, very important lesson here. On our cash budget, we are projecting that we are going to be cash flow negative. In this case, just for the first month. In the real world, might be for multiple months, might be for the entire year. Before you open up a business, you want to do a cash budget for the first several years and see exactly how much cash on hand you are going to need to be able to cover your bills and to make sure, or to help lower the chances that you're going to have to declare bankruptcy. All right, so what have we done? In the previous videos, we did the assumptions page, we did the accrual budget page. In this video, we did the cash budget page. I think we've got ourselves a very nice looking spreadsheet here with 3 sheets. Be sure and go up to the assumptions page, click in cell A1 here, and hit the save button. And make sure to save your work often. And at this point, I think this would be acceptable to turn in. If you're a little more advanced, if you want to add some color, some other formatting to make it more attractive, that would be a great thing, but for our purposes, not required. As always, if you have any questions on what we did in this video, please give me a call or send me an email. Thanks.